the important thing about an investment philosophy is that you have one and you stick to it. David Booth, co-founder of Dimensional.
Are you ready to make the most of the only life you have? To make smart money choices focused on achieving what you care about most? Here to help you balance living well today without sacrificing your tomorrow is the retirement answer man, Roger Whitney.
So I have decided to get on the smart thermostat bandwagon. Now, those things aren't cheap. They can be $200, $250 a piece, and I need two of them. When I was at Joe Sosei's house, the host of Stacking Benjamins, about a month ago, and we were playing geeky board games, I was sleeping over in a spare room, which was in a separate part of the house, and he showed me on his smartphone how he adjusted his Nest thermostat to make me comfortable in that room. And that was pretty cool, and he raved about the Nest. So the other day I decided I need to do this because I work at home a lot. I got 2 zones in my house, and I want to be energy efficient. So I went online and started to evaluate, obviously started with the Nest, which is the most popular, owned by Google. And then I looked at the Ecobee 4, which is a competitor, and then the previous generation of the Ecobee, the 3. And so I had these 3 different products, smart thermostats, and I wanted to buy one of them, but I wasn't sure which one. So what did I do? I looked at the features of each of the products, the things that were hardwired into them. So the Nest could learn based on habits because it has some motion sensors, I guess. The Ecobees can't do that. But the Ecobees come with a remote sensor, so you can also measure separate parts of the house where the thermostat isn't. All of them are integrated with Alexa if you use an Alexa device, although the Ecobee 4 actually acts like an Alexa device, and that's really the only difference between the 4 and the 3. So I was going through all of these features, trying to figure out which one made most sense for me. The Nest was owned by Google, so it connects well with Google stuff, but the Ecobees connect well with the Apple ecosystem. So these are all the things I was evaluating. So what did I end up deciding? I bought the Ecobee 3 because it was $70 cheaper. It was like $180 than the other 2, and it pretty much had all the same features except for some fancy Alexa stuff. So I'm going to install those this weekend. But that's how we buy products. When we're going to spend money, we look at the features that are hardwired into them with the expectation that we get those if we buy them. Now that works well with a physical product. Where it doesn't necessarily work as well is when you're choosing an investment strategy to invest in. So imagine you have some money and you want to invest it for growth. Let's just call it aggressive growth. You're probably going to go to Morningstar or some other online site and evaluate the performance of various growth funds, as an example. And typically, this is including advisors, we're going to look at past returns or past performance. And when we come to 4 or 5, we're going to look at which ones performed the best in the past and which ones had lower returns and try to make a value decision there. But the thing is, even though we know past performance is not a guarantee of future results, we're still hardwired when we're looking at it. It's almost ingrained in us that, oh, if I buy that, I get that feature. But unlike a thermostat where the features and benefits are hardwired into it, in an investment strategy, they're not. That's the past. So we're looking in the rear view mirror to try to evaluate what we're going to get in the future, but we just intuitively assume, hey, I want that higher performer one. So what ends up happening a lot of times is when we do this research and we can dive into the statistics, we can feel like we're making a very prudent decision. But what will happen is, and what I've seen happen, is that as markets cycle and different asset classes go in and out of favor, the one that had the best past performance that we bought at point A, when cycles turn, could go out of favor and other things go into favor. And then after a year or so, or 2 years, when you're reevaluating, it's like, wow, I'm not getting what I thought I was getting. And then maybe you become patient, but then you look again and you're like, I'm still not getting what I'm getting. In fact, this is not performing well. Let me just go look at my other options. So we go back to Morningstar or whatever, and we see other companies or investments that have really good past performance. And I'm like, well, maybe I made a bad decision. Let me go buy that one. And we do. And then what happens? The cycles change again. And this is proved out when you look at studies showing inflows and outflows of mutual funds and various investments. Investors typically buy the things that performed well in the immediate last period of time, and they sell the things that are out of favor. And they do it over and over and over again, because I think we're hardwired to buy these features. So this is what we need to figure out when we're trying to do manager due diligence. We got to try to avoid this cycle that seems to be rational, but really is a buying behavior that's more apt for a physical product than an investment product. And that's what we're going to try to deal with in today's episode, right after this disclaimer. Well, it's time for that all-important disclaimer, so I'm going to try to be a little bit more serious here. Don't take advice from me on the show. I don't know anything about you. In fact, I don't give advice to friends. I only give advice to clients where I know enough about them to give informed advice. And I'm working for them as a fiduciary. We don't have that relationship, at least yet. So before you make any decisions, talk to your legal advisor, your tax advisor, or your financial advisor. Now, we're talking about investments here. And a lot of times I get asked to talk about specific investments on the show or make recommendations. And I can't ever do that. Unlike a lot of bloggers and podcasts, I am a practicing professional, and I have a lot of regulations and code of ethics that prevent me from doing that. And to be honest with you, I wouldn't do it anyway. I don't give investment recommendations to friends that I'm having a beer with. I'm not going to do it without having gone through the process that I've developed over a long period of time. So we're talking about investments. Now realize, if we talk about indexes, you can't invest in a specific index. They're an unmanaged model. Different types of investments have different levels of risk, so you need to evaluate those for yourself. And past performance is never a guarantee of future results. Now, let's talk about how well mutual funds do in general in the Hot Topics section. So in the Hot Topics segment today, we are going to look at the 2017 Mutual Fund Landscape Report, which was just released by Dimensional. Now, Dimensional is a very academically rigorous investment manager. They manage about $500 billion in assets based in Austin, Texas. And they have been tracking the mutual fund landscape for a number of years to glean and look for clues as to how reasonable is it to assume that we can pick managers that will add value over and above their expenses. So I thought we would dive into the report a little bit. Now, just so you know, you can get a copy of this report. I will include a link to it in 6 Shot Saturday for the next 2 Saturdays. So if you go to rogerwhitney.com and enter your first name and email, you'll be assured to get those Saturday emails. And that's the only way you're going to get this report, at least from me. So if you want to get those, go to rogerwhitney.com and sign up for 6 Shot Saturday. So let's look at some of the highlights of this report. So the study looked at about 4,000 mutual funds, about 1,000 in the fixed income category, about 1,000 in international equity, and the rest in U.S. equities. Combine these 4,000 funds that they've been tracking and looked at, they manage about almost $7 trillion in assets, which is a lot of money. So what are some of the conclusions of this report? The first one that I thought was interesting was the disappearing funds. The fact that many of the funds that they had been tracking disappear over time. They just go away. Now you may ask, how does that happen? Generally, it can happen in 2 ways. One is they just close down, which is a little bit unusual. Most likely, they get merged into a different fund, and then that track record of the one that got merged just goes away. So that's usually how they disappear. And they looked at 5, 10, and 15-year periods, but let's focus on the 10-year period. So in the fixed income category, of the roughly 1,000 that were tracked, at the end of 10 years, only about 673 were still around. So that's 66%. So 2/3 were still around, but 1/3 of them were closed in some fashion. In the equity category, of the roughly 2,900 equity mutual funds tracked, at the end of 10 years, only 58% of them were still available and actively managing assets. So almost 40% of them, or a little over 40% of them, disappeared. And what's interesting as time goes on, if you look at the 5-year, the 10-year, and the 15-year numbers for the number that were still there, as time goes on, more and more of them disappear. This can be important because when we're investing, we're trying to buy quality investments or mutual funds that we can stick with for a long period of time to help us towards our goal. So a lot of them just simply disappear. I think the second interesting fact was the performance relative to the benchmark that they are trying to track. So if we think of buying a mutual fund, we're trying to buy something that's going to add value over and above a lower cost option, such as something that tracks an index. So let's look at that. In the fixed income category over a 10-year period, of the remaining funds, not the ones that disappeared, but the ones that are still there, in the fixed income category, only 26% of them had outperformed the benchmark or the index that they are tracking against over a 10-year period. So only about a quarter of them were quote unquote winners. In the equity category over a 10-year period, of the ones that survived, 21% of them beat the index that they were tracking, the bogey that they were trying to add value over and above. And as time goes on, less and less funds performed based on the results of the study. So if we go out to 15 years, the numbers get even lower. So we have a lot of funds just simply disappear over long periods of time. And then as time goes on, there are fewer and fewer winners relative to the benchmark that they're trying to add value over and above. Now, what if we just took the winners? Let's look at the winners for a second. And let's say we take the top quartile of the 5-year performers. So we look at all the equity managers and we say, okay, let's take the top 25% of the winners, the ones that really outperformed. How did they do the next year? Well, on average for equity managers, only 23% of the top quartile over a 5-year period outperformed in the next year. And for fixed income managers, it was about 27%. So even buying the best of the best isn't really going to get you outperformance in the next period of time. Now, step back for a second and think about that. The challenge you and I have when we're trying to build a portfolio to help us achieve our goals is we want to buy things that will execute on the strategy, the asset allocation policy that we've set. And if we're going to choose a manager that typically has a higher cost, we want to get value for the extra money that we're paying. And the hard part is we have to be right in advance, right? We have to be right in advance. And when you start to do the statistics and run the numbers, it gets harder and harder and harder to try to be able to pick the one that's actually going to be left standing over a typical investment timeline. Another highlight I want to point out is they also looked at cost. So they looked at 5, 10, and 15-year periods for those funds that had the highest costs in the pool or the sample that they're studying. And what they found is the ones in the highest cost category had the lowest percentage of winners and the highest percentage of losers. Makes sense, right? So costs definitely do matter when it comes to performance. And then they looked at another thing, and this is the last one I'm going to pull out as a highlight, is turnover. So what is turnover? So turnover is a measure of how often a investment strategy or mutual fund trades its portfolio, the portfolio that you own a portion of. So a 100% turnover ratio would mean that in a 1-year period, they're replacing all of the stocks. So they only hold stocks on average a year or less. Whereas the smaller the turnover ratio, the less trading they do in the portfolio. So when they trade, you have costs. You have tax cost and you have the trading costs that go into trading, buying and selling different types of securities. So when they looked at turnover, the higher the turnover, as you would think, the more losers they had and the less winners they had in terms of outperforming the benchmark that they were trying to track. So what are some of the takeaways from this? One, outperforming funds are in the minority. Strong track records seem to fail to persist over time, and high costs and excessive turnover may have contributed to some of that underperformance. It's an interesting study. I love that they do it because it helps us understand what we're facing when we're trying to pick an investment strategy and we're trying to buy something that's going to help us towards our goal and be worth the extra cost we likely are paying in terms of investment fees. So again, if you want a copy of that, make sure you're signed up for 6 Shot Saturday, and you can do that at rogerwhitney.com. Now, let's get into actually some due diligence. How do we fill these pieces of the pie? How do we pick the right strategies for us? So when we're trying to invest wisely for retirement or during retirement, now we got to figure out how to fill the pieces of our asset allocation bucket. And last week, we talked a little bit about how I think about it and where I've come to in terms of mixing art along with the science of asset allocation and modern portfolio theory. But how do you actually pick the investment strategy or the manager or the mutual fund or the investment to put those pieces together? That's what we're going to start to dig into today. Now, my strategy that I've come to is fixed and flexible, where a portion of the assets are invested in more of a fixed asset allocation using more passive investments. And we're going to talk about those next week. There's so much stuff to talk about here. So we're going to deal with index-like investments and the different options available for that fixed bucket next week. What I want to focus on this week is how do we choose investments for the flexible bucket? How do we choose wisely to hopefully best position ourselves to achieve the goals that we want as a family? So that's what we're talking about today is the flexible bucket. So the objective here is pretty high. We want to know, could these help us move towards our retirement goals? The only reason to include an investment, well, I said the only, there's always lots of reasons, but one of the big reasons to include an investment in your portfolio is because you have some degree of confidence that it can help move you towards the life that you want to have in retirement, especially in that decumulation stage. It could mean that it's producing income. It's helping throw off more income than the fixed bucket might. It could mean that it's protecting capital, meaning moving away from overvalued assets and moving towards lower priced assets to give you a smoother ride so you can mute some of the volatility. It could also mean that it's growing capital or has the potential to grow capital over and above the fixed allocation. Those are some of the reasons why we want to try to accomplish and even using a fixed bucket like this. So the bar that we're going to set in the due diligence process is we're going to have some confidence that anything that we use in our portfolio is going to have value over and above the fees and possibly tax consequences of a more passive investment. Like I said, we'll talk about those next week. That's one bar. We got to feel like, okay, we're getting value for the money that we're paying, because typically they'll have a little higher expense ratios, some a lot higher. The second part of that bar is we have to have some confidence that they can repeat what they've done. We're going to talk about how to do due diligence on gaining that confidence, but all we care about is repeatability. We don't have confidence that they can repeat what they've done, then it's not worth the trouble here. And that can be a hard thing, because remember, we're not buying a thermostat, right? We're not buying something with fixed features. We're looking at data and clues that are not fixed. So this is a challenging process. So if that's the bar, what are some of the challenges that we face? Well, one challenge that we face is that everything looks good on paper. Whether it's a real estate investment, an investment strategy presentation, or fact sheet, they all pretty much look good on paper. If once you weed out the real bad ones, all the numbers work on paper. I've never really seen a proposal that didn't look good on paper. That doesn't mean they are good. Numbers can be deceiving. So one, they all look good. The other challenge is that we're wired to buy products. So if everything looks good on paper, we're wired to look at those as features, just like a thermostat, and assume that it's a absolute when it's really not. The third challenge is we have the media always telling us about what we should be doing and what we shouldn't be doing, and tempting us with the next thing and the next thing and the next thing. Because let's say you pick a flexible strategy. Well, it doesn't mean it's always going to be in favor and outperforming anything. If it's meant to have a smoother ride, it may always underperform on an absolute basis, but because the risk-adjusted return looks good, it helps you reach your goals. So we're going to have the media as a challenge to us. The other next challenge is your emotions. We get pessimistic and we get optimistic during different parts of the economic cycle and what's going on in our lives, and that can really affect our decision making. And the last big challenge that I can think of is, we all have very long-term objectives when we're entering retirement, but we have short-term emotions and short-term reactions that can really short-circuit wise decision-making when we're managing our investment assets. So that's the challenge that we have in front of us when we're choosing investments. And that can work for the fixed bucket or the flexible bucket. So that's what we're facing here. Let's look at the due diligence process when you are looking at an investment manager or mutual fund that you're considering to buy, or maybe you already own it and you want to know if it's the right one for you. Now, just a side note, we use a due diligence process that's pretty robust, I think, relative to what I've seen over 25 years. I would wager to say most advisors don't have a detailed due diligence process that they use. And I'm not saying that I don't know how I'm saying it. I'm just saying it as my observation. Also, most individual investors don't have a robust due diligence process when they're investing their money. Because it's hard. There's a lot of variables. We're looking for clues. It's not buying a thermostat. So it's very easy to just buy the number of stars on a Morningstar report, or to buy what a friend has, or just look at the past track record and wing it. I get that because it takes a lot of time. But that type of undisciplined decision-making can lead to second guessing and going through the cycle of constantly buying and selling different things over a year to 2 years as cycles change. And it can really hurt us over the long term. And I've learned this from personal experience in going through all of that and becoming more disciplined as I've matured as an advisor. Anyway, so we're going to talk about the P's, okay? The people, the parent of the investment, the process, the performance, and the specific product, okay? So I can't share everything that I do because it from my perspective, because it's a checklist of, probably 100 different items that happen over periods of time. But we'll talk a little bit about each one of these. So let's go to the first P, the people. So we're talking about who is managing the investment. So we want to know the manager structure, right? Is it a single person or is it a team approach? And then if it is a single person, who's behind the person that is either being mentored or can step into that person's place? Because if one person leaves, if it's a single manager type of investment and that person leaves, say a mutual fund, well, when the new manager comes in, it's basically an entirely new fund or entirely new investment, because that new person is going to have their own philosophy. Even if they have a process that they're following, they're going to have their bent on it. In my practice, we've liquidated large positions in particular investments simply because the investment manager changed, because we had to start the whole process over. You can't look at the track record. You can't look at anything else. So if you're buying, say, an investment in a mutual fund and you're looking at the track record as part of your indication of what you might expect or as an indication of skill, well, if it's a great track record, but the manager changed last year and you didn't know that, well, everything you just looked at really wasn't worthwhile. You want to know the tenure of the manager. You want to know their compensation structure. That's the third one. You want to know their compensation structure. Are they compensated on performance? And if it is compensation on performance, what performance? Short-term performance? Long-term performance? How is that compensation paid? A lot of times you can look at where the incentives are to understand people's behavior, especially when it comes to money. If they're compensated on performance, but the measure is really rewarding shorter-term performance, then human nature being what it is, that may influence that person's decision. And then lastly, it's good to know whether they have personal money in the strategy that they're managing. And if so, how much do they have in the strategy they're managing? Are they eating their own cooking? So those are some of the things you need to go through and have some comfort in when you're looking at the first P, which is people. Now let's go to the second P. What about the parent? So what would be the parent? Well, name any big mutual fund complex. So if we're just talking about mutual funds, the company, and then the company will probably have a lot of different mutual funds underneath that they offer, right? We want to know the ownership of the parent, whether they're public or private, who makes up the ownership, what's the culture behind the firm, what's the culture that drives the entire firm. Some of them have very defined cultures, some of them really don't. We want to know the history of their product maintenance and development. So if a particular fund, in this case, is a product from their perspective, how do they maintain and nurture and improve that product? And then what are they doing in terms of development of product? I'll use a metaphor of if you're buying a dog, right? If you're going to buy a dog, you can buy a dog from a puppy mill. They just constantly turn out puppies. There are mutual fund companies and investment firms that do that. They just are always coming up with new product to meet the demands of the market, depending on what the market wants. There are other parent companies that very rarely come out with a new product. And then when they do, there's a lot of thought behind it. So if you're buying a investment that looks solid, but the company doesn't show you that they are maintaining those products well, or they seem like a puppy mill, there could be a mismatch there. It may not be a deal killer in using that particular product, but it's a red flag that you need to watch out for. Let's talk about process. The third P. What type of investment process is used to build and manage the portfolio that we're considering owning? Now, if it's a relative performer, like we talked about last week, there are issues, right? We need to know, okay, how tied to their index or to their benchmark are they? And how much freedom do they have to actually make decisions? Now, we are assuming for this discussion that we are looking at flexible strategies that, although they track an index in terms of a benchmark, they have a lot of rope or a lot of freedom to lean away or towards lots of different securities in a particular asset class or lots of different asset classes depending on the flexibility of the strategy. So here in this process, we need to know, okay, how much flexibility do we have? How much rope do we want to give them to lean one way or the other? And that can be all over the board. There are strategies that literally can be all cash, or they can be leveraged upwards to express their opinions. I tend to not like wide open strategies. I like to have reasonable constraints that allow the manager to act on what they're looking at doing, but also stay within the bounds so they're not making any huge bets in any one direction. But we need to understand the process that they follow. Some funds or strategies look only at technicals and they're momentum driven. Others are very fundamentally value based and they're looking at balance sheets. It's important to understand the type of process that they use, regardless of the track record. So this is where you really want to dig in and understand, okay, how are they making decisions? You want to understand how they are implementing those decisions. Some firms have a process where they buy individual securities. They buy the specific securities. And I know of managers where if they believe in a particular class of securities, they'll never actually own the securities. They'll buy derivatives or synthetic instruments that theoretically give you exposure to those particular asset classes. And that can be a big difference. Now you've just introduced a whole nother level of risk and possibly excess return by using derivatives rather than using the actual investment itself. So we want to make sure that we understand that. We want to take a look at their past decisions. So not just the performance, but from a process standpoint, if they have a robust track record, and we'll get to that in a minute, we're going to want to know, okay, well, let me see how much you've actually exercised discretion in being flexible. What if they have a flexible mandate, but really they just hug the benchmark or the index that they're following, and they never actually use the discretion that they have? There are managers like that. If we're going to hire someone to be flexible and we're going to pay them a little extra in expenses, we want to see that they're actually expressing their views to our benefit, hopefully. We want to look at the past allocation decisions. Are they riding the tides? Meaning, are they making big positioning moves? Or are they looking at the waves, and are they just trading a lot and trying to pick up nickels and dimes in a very hyperactive strategy? That is part of what we're trying to look for and understand in the investment process. In my experience, having looked at, I don't know how many, hundreds, if not thousands of different investment strategies, simple, understandable is important. Because there's a bunch of stuff out there. It should be relatively easy to understand what the process is and how they view the world and how they think and how they make investment decisions. So let's go to the next P, the P that everybody loves, performance. So performance, we think of returns, right? What are the returns that have happened in the past? And sure, that's important. We got to look at that. And again, I'm just touching on some of the things that I key on when I'm doing due diligence on investments. When it comes to, say, a mutual fund strategy, one thing I do that makes my life exceedingly easier is, except for sometimes small satellite positions, I do not look at anything that has less than a 10-year track record. That's the minimum. That eliminates a lot of the noise because there aren't as many strategies as you think or mutual funds that have 10-year track records. So that is a good bar to set. Looking at something that has 3 to 4 or 5 year great performance and everything else works, well, that's not enough data to really tell you anything. It could just simply be luck. Honestly, luck has a lot to play into it because of survivorship bias and other things like that. But that's a whole nother discussion. So I don't look at anything with less than a 10-year track record for major positions. And then, yes, we're going to look at returns relative to the benchmark that they're tracking and relative to the peers in their group. That's important. We're also going to look at risk. We're going to use standard deviation. How volatile has it been in the past? We're going to look at beta, which is how volatile it is relative to the index that we're grading it by, and also against the peers. So we're going to look at the risk end of it. And then we're going to look at risk-adjusted returns, things like alpha and Sharpe ratio and other types of things relative to the benchmark and relative to peers. Those are things that take risk into account when it's looking at performance. Because if investment A outperforms investment B, well, maybe investment A took 3 times as much risk to outperform. So we try to, you try to adjust for that. We're going to look at tax efficiency and turnover, because that is, and obviously we're going to look at expense ratios and things like that. So those are some of the things that go into the performance. Some of this is qualitative assessments. Some of this is strictly qualitative assessments. So there's a little bit of art and science to this as well. But again, it has to be in the mind of I'm trying to build an overall portfolio that is going to help me and my family achieve what I want to achieve. That's got to be a high bar of what we allow into the investment portfolios. The last P, which is product. So if we have a company, what is the specific product? And we're going to look at expense ratio. We're going to look at the turnover, because that goes to tax efficiency, and it also goes to trading costs, which you never actually see. We're going to look at what benchmark they're trying to meet. We're going to look at the portfolio construction, the limitations, just more of the operational types of things. So these are some of the things that you want to look at when you're doing your initial due diligence. And then you're doing this on multiple pieces of that asset allocation pie, or however you're building your portfolio. So they all sort of have to work together. And then you're going to want to do some ongoing due diligence so you can identify changes early. I always talk about, having lots of little conversations. Well, it's that way with managers too, or investment strategies. Assuming they're liquid, you want to know what's going on. So if the company is sold, or a manager leaves, or all of a sudden they're executing their process in a way that you've never seen before, it's good to know that on the front end rather than the last end. A good example is that back in the late 90s, value managers, which is a strategy that typically looks for undervalued assets, or you're buying them at a reasonable price, they were really out of favor because we had the technology boom going out of the 90s. If you were a value manager, and I've talked about this before, you were underperforming almost any other large equity strategy. So what ended up happening is a lot of value managers creeped because they know investors and advisors buy performance. They creeped and started to buy things that weren't in their core objective, in this case, growth stocks or technology stocks. So although they were called a value strategy, they deviated from their process and started to buy some things because they were trying to help performance and deal with the business side of things. That's what we don't want, because we're buying different pieces for different reasons. Now, I know this seems like a lot, and it is. That's why most people don't do it. Most advisors don't do it, or they let somebody else do it for them. And that's why we just buy a strict asset allocation and forget about it. It just seems so much easier. And in some ways it is. But when we're trying to build a great retirement in the decumulation stage, it's not quite as easy as that. Or I don't believe it's quite as easy as that. And we got to make sure that we always understand what we're trying to accomplish. It's not being the greatest investors in the world. It's trying to eliminate uncertainties and manage as prudently as we can in the decumulation stage or retirement stage of life. So next week, what we're going to do is we are going to look a little bit at the fixed bucket, and I'm going to talk about indexes and how they're constructed and some various ways that people do that, so we can make sure we are wise about how we do that as well. Now remember, all investments have different levels of risk. Make sure you talk to your financial advisor or you evaluate those, and performance is no indication of future results. Now, let's get to the smart sprint of the week.
On your marks, get set.
All right, you ready for your smart sprint for this week? In the next 7 days, look at your holdings, the particular strategies you own, and write some bullets as to why they make sense. What's your rationale for buying them and owning them? And then ask yourself, as part of the whole, are they helping you achieve the retirement goal that you and your family care about? All right, get to it. Now let's go get happy. Hey, welcome to the Happy Lab. So, over the last couple weeks, I had two friends have two really bad things happen to them. The first friend had an unexpected development in his business that really abruptly changed how he has to operate his business going forward. And the change affected something that he had nurtured and invested money in and time in and a lot of passion into. And all of a sudden, there were some changes that were outside his control that he couldn't battle, that had to change everything he did. Imagine that. Now, my second friend had abrupt change. One day, his wife and a few of his kids were at home, middle of the day, decent day, partly cloudy, no rain. All of a sudden, the house starts to fill with smoke. They rush out. They grab some basic things from the house. And even though there was no rain, their house was struck by lightning. And the fire started in the attic and nurtured and built in the attic and then started to go into the house. So they're going to have to rebuild a lot of the house. They didn't lose all of their possessions, but they're displaced from their house. And thank goodness the family was able to get out. Pretty major change. How would you react to having your business totally blown up? Not blown up, but having to alter the course of something that was fundamental to it. How would you react if today your house caught fire in some freak thing that no one could have predicted? So I have the pleasure of spending a lot of time with these two. Let me tell you how they reacted. They reacted by asking themselves one question with the right attitude. What does this make possible? Now that I can't do my business this way, what does it make possible that I can do that maybe I was holding back on? The gentleman whose house caught fire. What does this make possible for my family and I in terms of where we live and what we're going to do? They both approached it, and I'm not kidding. They had the most positive, abundant spirit about this and focused on what does this make possible for us that we might not have considered before, and they were making the most of it. Now that is a beautiful thing, and I think that's a great attitude to have if you want to be happy. Now, a quick note on the gentleman whose house caught fire. We were talking to him, okay, what things were you really happy that were in place that you may not have thought of, but realized, hey, I'm glad I had that with this house? He gave me 3 things. He said, 1, he was glad he had some documentation of his valuable possessions, video documentation. 2, he was glad that his home insurance had displacement coverage, meaning that if they were displaced from their home, they were covered to pay the bills of living where they had to live. And 3rd was he now realizes, and the fire marshal confirmed this, no homes have smoke detectors in their attics. And they said that's a really important thing to have, because if a fire starts there, nobody's going to know until it's way out of whack. So there's some healthy tips for you too along your journey to be happy. Well, this was a long one today. Hopefully you got some value from this. Now, most people I talk with really don't feel confident in what their retirement's going to look like and how to really approach it all. Now, we have an agile retirement management process that really helps provide clarity and structure in not just the life planning, but the investment management. Now, most of our clients, it seems they feel more control and optimistic when they know we're having these set little conversations and walking this journey together. If you are looking for a financial advisor or want to get a checkup on where you're at, go to rogerwhitney.com and let's have a discussion on how I might be able to help you. Next week, we're going to talk about the fixed bucket and indexes and how those are constructed and different types of things. As always, I so enjoy this time together. Until next week, this is Roger Whitney, the Retirement Answer Man.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.